Thank you for visiting Simple Investing Secrets. In this video, we'll go over our guide to investing in dividend stocks for passive income. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Any income investor should own dividend stocks, but don't assume that only retirees should do so. Dividend stocks have a place in any portfolio, regardless of the investor's age or financial situation. The reason is compound interest. When the dividends these stocks pay are reinvested, an investor's wealth snowballs. The more dividends you reinvest, the more shares you own, and the more shares you own, the larger your future dividends will be. Historically, the total return of the S&P 500 with dividend reinvestments has significantly outperformed the index without reinvestment, says Peter Shea, a senior wealth advisor for U.S. Consumer Wealth Management at Citi. There are numerous investment methods available. Buying dividend stocks is a well-liked method of investing for people who want to generate income. These stocks regularly distribute cash to investors, frequently in quarterly increments but occasionally in other ways. Investing in dividend stocks works the same way as other investments, but does require a certain strategy. Work with a financial advisor if you want help investing in dividend stocks and other income-producing securities. What are dividend stocks? Dividend stocks are stocks that regularly pay dividends to their investors. Companies that pay dividends tend to be established and consistently earn a profit. Dividend payments are often monthly, but they can use other schedules, such as monthly or semi-annually. Dividend stocks don't necessarily have the highest returns, but investors often appreciate their dependable income. Tech stocks fresh out of an IPO can have eye-popping share price appreciation, but these companies don't usually pay dividends. Dividend stocks can fill in the gap while investors wait for their portfolios to grow. Dividend stocks are frequently issued quarterly because they are frequently issued by publicly traded companies that hold quarterly shareholder meetings. This is when we find out if a company earned a profit in the previous quarter. If so, the company's board can elect to share its profits with shareholders in the form of dividends. Why do people invest in dividend stocks? Even though dividends aren't guaranteed, many investors rely on them as a source of income. Dividend-paying stocks are a great way to meet income needs while still participating in potential capital appreciation, says Chris Huemer, senior investment strategist at FlexShares ETFs. The capital appreciation component is especially important in periods of high inflation, when increasing asset values can offer a layer of protection against rising expenses. Since companies pay their dividends at different times, retirees can create a schedule to receive a dividend check each month of the year. Meanwhile, younger investors who may not need the income now, can put those dividends to work immediately in their portfolios by reinvesting them. Dividend reinvestment plans automate this process, but even if you reinvest your dividends, they are still taxed the year you receive them. The exceptions are dividends in a tax-advantaged account like an individual retirement account, where the money grows tax-free until it's withdrawn. Dividend stocks also often benefit from higher yields than bonds when interest rates are low, while simultaneously offering the potential for share price appreciation. Even if the price falls, the dividend can cushion a portfolio with steady income, and if you reinvest those dividends, a lower share price gets you more shares per dividend. You need only look back to the lost decade following the tech bubble to see how dividends can buffer a stock portfolio during hard times. This may be especially important in today's equity markets as rising labor and material costs and continued monetary tightening can depress asset values for the next several years. Why companies pay dividends? A company may offer dividends because they are typically a sign of sound financial condition in order to entice investors and raise the share price. According to Jacques L. Millet, a chartered financial analyst, senior portfolio manager, and director of research at the Colony Group, corporations that have the financial capacity to pay their shareholders dividends often have stable businesses that may exhibit greater financial strength and discipline than non-dividend paying stocks. Companies typically pay dividends when there is money left over after covering operating costs and reinvested profits. Because of this, established businesses are more likely to distribute dividends because they require less capital reinvestment. Why companies don't pay dividends? On the other hand, a young, rapidly expanding company frequently needs to reinvest all of its capital to support growth and is unable to afford to pay a dividend. Due to the fact that dividends are taxed at ordinary income rates, some investors prefer this. If a non-dividend paying company reinvests its capital and grows, investors benefit from the rising stock price, a gain that isn't taxed until they sell. A mature company may also choose not to pay a dividend in order to reinvest or pay costs. This can be a bad omen for investors, particularly if the company is under financial strain or anticipates slow future earnings. So be selective when buying dividend stocks. How to invest in dividend stocks. Dividend stock investments can be made in a variety of ways. The simplest way, though it may not always be the best, is to purchase dividend stock shares in a brokerage account. For instance, you can also buy dividend stocks in an IRA. Here is a quick rundown of ways to buy dividend stocks. Invest in companies that pay dividends. As mentioned, investing in dividend stocks can be as simple as buying shares of the companies that regularly pay them. Some companies have been paying dividends for years, so you can probably expect that to continue. In fact, some companies are known as Dividend Aristocrats because they have raised their dividends for at least 25 years in a row. The companies with a long history of paying dividends are names you have likely heard, such as the Coca-Cola Company, Procter & Gamble and Eli Lilly. These companies are publicly traded, so you can invest in them using any type of account you like, brokerage, IRA, HSA, etc. On the other hand, there might be tax repercussions, more on that later. Invest in dividend ETFs or mutual funds. While it is possible to invest in individual companies that pay dividends, it may not be the most convenient. You will need to identify the companies through independent research before investing in each one. Alternatives include mutual funds that focus on dividend-paying stocks and exchange-traded funds, ETFs. For instance, you could purchase shares of the iShares Core High Dividend ETF, HDV, or the SPDR S&P Global Dividend ETF, WDIV, respectively. Because of their high diversification and stable yields, these ETFs do the work for you. Dividend yield and other key metrics. Before you buy any dividend stocks, it's important to know how to evaluate them. These metrics can help you understand how much in dividends to expect, how reliable a dividend might be, and, most importantly, how to identify red flags. Dividend yield. This is the annualized dividend represented as a percentage of the stock price. For instance, if a company pays $1 in annualized dividends and the stock costs $20 per share, then the dividend yield would be 5%. Yield is useful as a valuation metric when you compare a stock's current yield to its historical levels. All other things being equal, a higher dividend yield is preferable, but it's more crucial for a company to be able to continue paying dividends and ideally increase them. A high dividend yield, however, might be cause for concern. Dividend payout ratio. This is the dividend as a percentage of a company's earnings. If a company earns $1 per share in net income and pays a 50 cents per share dividend, then the payout ratio is 50%. In general terms, the lower the payout ratio, the more sustainable a dividend should be. Cash dividend payout ratio. This is the dividend as a percentage of a company's operating cash flows minus capital expenditures, or free cash flow. This metric is important because GAAP net income is not a cash measure, and a company's earnings and free cash flow can change a lot from one period to the next because of non-cash costs. This variability can render a company's payout ratio misleading at times. Investors can use the cash dividend payout ratio, along with a simple payout ratio, to better understand a dividend's sustainability. Total return. This is the increase in stock price, known as capital gains, plus dividends paid. For example, if you pay $10 for a stock that increases in value by $1 and pays a 50 cents dividend, then the $1.50 you've gained is equivalent to a 15% total return. Earnings per share, EPS. The EPS metric normalizes a company's earnings to the per share value. The best dividend stocks are companies that have shown the ability to regularly increase earnings per share over time and thus raise their dividend. A history of earnings growth is often evidence of durable competitive advantages. PE ratio. The price to earnings ratio is calculated by dividing a company's share price by its earnings per share. The PE ratio is a metric that can be used along with dividend yield to determine if a dividend stock is fairly valued. High payout versus dividend growth. There is no right way to invest in dividend stocks. There are numerous dividend stocks and dozens of dividend ETFs. Among dividend ETFs, there are dozens of choices, all with different strategies. For example, some dividend ETFs might simply focus on high payouts. Others include dividend appreciation ETFs or Dividend Aristocrats. The latter concentrates on dividend stocks whose dividends have steadily increased. Each type of dividend ETF has a different investment philosophy. Of course, the highest dividend yields are typically found in dividend ETFs with high payouts. High dividend yields, however, are not everything. Consider Dividend Aristocrats if you want a more stable way to invest in dividends. Dividend Aristocrats offer steady, long-term dividend growth. The best option thus depends on your preferences and investment objectives. Dividend investment strategies. There's a misconception that dividend stocks are only for retirees or risk-averse investors. That's not the case. You should consider buying dividend-paying stocks whenever you start investing to reap their long-term benefits. Stocks that pay dividends, especially those from companies that keep raising their dividends, have historically done better than the market and been less volatile. Because of that, dividend stocks are a great fit for any portfolio as they can help you build a diversified portfolio. There are a few dividend strategies to consider. The first is to build a dividend portfolio as part of your overall portfolio. When you're building a dividend portfolio, it's important to remember that paying dividends isn't obligatory for a company in the same way that companies must make interest payments on bonds. That means that if a company has to cut expenses, the dividend could be at risk. You cannot eliminate the risk of a dividend cut, but you can lower the risk. Focus less on a company's dividend yield and more on its ability to consistently increase its dividend. Look for a company with a sound financial profile focused on a growing industry. Another aspect of a dividend investing strategy is to determine how you want to reinvest your dividends. Some investors opt to reinvest their dividends manually, while others use a dividend reinvesting plan, also called a DRIP. This means that every dividend you earn and reinvest it without fees or commissions back into shares of that company. This simple set it and forget it tool is one of the easiest ways to put the power of time and compounding value to work in your favor. Another dividend investing strategy is to invest in a dividend-focused exchange-traded fund, ETF, or mutual fund as we mentioned earlier. These fund options enable investors to own diversified portfolios of dividend stocks that generate passive income. No matter what dividend strategy you use, adding dividend stocks to your portfolio can be beneficial. They can help reduce volatility and boost your total return so that you can reach your financial goals a little faster. How much should you invest in dividend stocks? The percentage of your portfolio to dedicate to a dividend strategy will depend on your risk tolerance, time horizon for investing, and income requirements. Remember that dividend stocks are not the same as bonds, which will give you back your original investment unless they go bad. Dividend stocks are susceptible to market and company-specific risks just like any other stock. In addition, dividend stocks face interest rate risk. When interest rates rise, investors may flee dividend stocks for the guaranteed income of bonds, prompting dividend stock prices to fall. That said, the defensive characteristics of dividend stocks can provide a lower volatility way to stay invested in equities during rocky stock markets. If an investor needs money from their portfolio to live, they can use the dividends instead of having to sell stocks at bad times. Tax considerations. Although dividends can have tax repercussions, they do provide a consistent source of income. Any dividend income from stocks you hold in a brokerage account must typically be reported on your tax return. Depending on the kind of dividends you receive, you may have to pay a different tax rate. Qualified dividends are taxed at a lower rate while some dividends are taxed as ordinary income. For 2022 to 2023, the ordinary income tax rate ranges from 10% to 37%. The rate can be lower for qualified dividends, such as 0%, 15%, or 20%. If tax avoidance is your top priority, you can hold dividend stocks in a tax-advantaged account, such as an IRA. Investing in dividend stocks is a great way to build long-term wealth. Dividend stocks are consistently profitable companies that share their profits with investors. Rather than relying solely on share price appreciation for returns, they provide investors with regular income. Though quarterly dividends are most common, they can also be monthly or semi-annual. While some dividend stocks have high payouts, others, known as Dividend Aristocrats, focus on consistently increasing dividends. There are multiple ways to buy dividend stocks, such as with individual positions or dividend ETFs and mutual funds. Ultimately, the choice comes down to personal preferences and goals. Making decisions about how to distribute your portfolio is not always easy. A financial advisor, however, can assist you in making the best decision. With the help of a financial advisor, you can make a plan to help you reach your goals. This concludes our guide to dividend stock investing for passive income. To learn about the best dividend stocks to add to your portfolio, check out these videos on the screen. And don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies. Thank you for watching, and best of luck with your investments.